Hi, I'm Phil Blackmore, Head of Wholesale Trustee here at Perpetual Corporate Trust. I'm delighted to have Josh Cardwell here with me today, who's the Head of Real Estate Tax at PwC Australia. Josh, welcome.
Thanks, Phil. Good to be here.
There's been a hell of a lot going on in MIT at the moment. Could you care to give us a helicopter view of the recent changes?
Sure. So probably the biggest changes that are coming through are the so-called staple changes, and they're broken into two sort of key areas. One deals with income, so recharacterization of income, and that's been a concern for Treasury and ATO for a while. And the second deals with deductions for interest primarily, and sovereign immunity. So if we look at the income side of things, what it's about is recharacterising active income to passive income. That's going to be prohibited from 1 July 2019. There are some quite good transitional rules, but what it's going to do is apply a 30% withholding to that recharacterised income. On the deduction side, what it's going to do is reduce the thin cap tracing rules. That changes from 1 July 18, and then from 1 July 19 changes to increase the withholding tax rate for foreign super funds from 0 to 10, and for sovereign wealth funds putting a statutory cap on the investments they can make and still get that sovereign immunity.
In a nutshell, if you're an investor, what are you thinking about all this?
Yeah, so I think the government's been quite smart in the way they've introduced the transitional rules. So there's a 7 or a 15-year concession. So not an immediate impact on current investments, but certainly will have an impact on exit values down the track. And it will have an impact on new transactions, in particular in the infrastructure space, privatisations, renewables and also agriculture.
Our view on things is that we feel the sleeper issue here is the removal of the double gearing. Have you got any views on that?
Yeah, so the double gearing issue historically, particularly in infrastructure sense, has been a club-based transaction. So you'll have a project vehicle with a number of investors, sort of 3 to 5 typically, each with their own MIT or feeder vehicle. Those feeders have been able to have debt in them, get benefits of a 60% safe harbour threshold. The project vehicle has also had 60%. So they've had what's called a double gearing benefit, and that's converted a lot of income that would otherwise be taxed at potentially 30 to 10, or in some cases where those investors up the top are sovereigns or foreign pension funds, to 0. So that's been a big driver or a big push from the local super funds to say, well, that's a competitive disadvantage to us, and that's the government's response. So again, that will change yields quite quickly, particularly because that change has no transitional provision and it's effective from 1 July 2018.
Josh, now that Treasury has landed on its final agricultural position, what's your take on that for investors?
Yeah, so originally the policy statement was that you couldn't have agricultural land in an MIT. You'd actually lose the flow-through status rather than just being taxed at a higher rate like all the other provisions. Ultimately, government have changed their view and have adopted a position where you can have agri in an MIT, you'll get the flow-through. That income, the yield will be taxed at 30%, so not concessionary, but doesn't jeopardise the broader fund. And capital gains will still be taxed at 15.
Josh, what's your take on the ATO's longer term strategy here?
Yeah, so it's clear that the ATO have got a lot of what they did want in this package. There are some concessions in there about the application of anti-avoidance or the non-application during the transitional period. It'll be interesting to see the approach the Tax Office takes to new stapled transactions, new structures, and also how detailed they look at whether those transitional rules are truly satisfied. We probably won't know in a lot of detail probably until the sort of 3 to 5 years from now, as we start to get more new structures and also that transitional period for sort of key class of assets start to unwind.
Josh, these changes, what does it do to Australia's attractiveness as an investment destination?
Yeah. So I think Australia still has strong fundamentals as an investment destination, and those aren't changing. The regulatory regime is impacting that, but globally is still competitive. Yes, this will impact the tax returns or after-tax returns to investments, but still, with careful planning and management, you can still get a very attractive after-tax return out of Australia.
Josh, I think that was an excellent update. Thanks for your time.
My pleasure. Thanks, Phil.